Hey, what's going on, everyone? It's Griffin here, and what a crazy past week it has been in the stock market, with most of all companies having now reported their Q3 earnings and some new information having been released about possible interest rate hikes both in Canada as well as in the United States to try and stabilize the higher than average inflation levels sooner than anticipated. In the American markets, new all-time highs across the board, with the Dow Industrial Index up 203 points on the day, the S&P 500 up 0.37%, reaching a new high of $4,718 in the day following the 7th consecutive positive trading day, and the NASDAQ 100 has remained flat at an all-time 52-week high of 16,454 points. Now, when taking a look at a smaller cap stock index like the Russell 2000 that I've previously spoken about, showing some nicer valuations than the large cap American stocks, well, the index actually jumped 1.44% on the day, which is nice to see since small and mid-cap stocks have been lagging behind the general market for the better part of 6 months at this point. Here in the Canadian markets, a strong jobs report indicating 31,000 new jobs having been added to the workforce in October, and positive earnings in the heavyweight energy sector has pushed the S&P TSX Composite Index up 113 points on the day to a new record of 21,455 after hitting an intraday high of 21,473 points. So overall, it's safe to say that the North American equity markets have responded quite favorably to the employment reports for October, with 500 new jobs having been added to the American economy, which is indicating that the economy is regaining some strength out of the pandemic, and this should also be more favorable to traveling moving forward, which will help the airline and hotel industries. In fact, these positive employment reports in both countries has created some excitement that we're seeing firsthand for stocks like Air Canada, up 18% over the past week. Now, in terms of actual company earnings over this past quarter and how this has impacted equity prices though, well, we've seen an extremely explosive quarter where year-over-year financial growth has been pretty fantastic across the board, especially for larger companies that make up the S&P 500. In fact, according to FactSet, for Q3 2021, as of this past Friday, 89% of S&P 500 companies have reported their financial results, and of these, 81% have reported a positive EPS surprise, and 75% have reported a positive revenue surprise. Essentially meaning that the vast majority of companies have beat analyst estimates on what they were expecting for both revenue as well as bottom line growth year over year. And usually this has a positive impact on equity price points. In terms of just how much financial growth though, well, right now we're seeing a blended earnings growth rate of 39.1% across the S&P 500, which is pretty staggering growth, even considering an easier comparison to weaker earnings per share figures back in 2020. And across all market sectors, all 11 have reported year-over-year growth in revenues led by the energy and materials sectors. What's also kind of interesting to note is that despite the markets moving towards all-time highs, the VIX index, which is a real-time market index representing the market's expectations for volatility over the coming 30 days, is down from mid to late September and down steadily over the past 12 months. And from a month back when I made a market update video in early October, the Buffett Fear and Greed Index has drastically shifted to a unanimous level of extreme greed as of right now, which historically tends to be correlated with shorter term corrections, but that's not a hard fact. Hey, I hope you're enjoying today's video so far. If you are, make sure to smash the like button. And I don't have a video sponsor, so today's video is sponsored by, well, myself. Make sure to check out the links down in the description to resources I use and recommend, as well as a discount code for my full stock market investing course. So this then begs the question, why are we seeing stellar financial performance pretty much across the board, which is pushing the markets towards new all-time highs? But regarding individual stock performance, there seems to be a pretty wide gap between what investors are excited about versus what's getting absolutely destroyed, where it would seem like expectations are even exceeding performance in some cases, right? So as always, FANG stocks like Microsoft, Apple, Google, and Facebook have continued to crush earnings and have either trucked along to new all-time highs themselves or are trading in and around those higher levels, which of course has continued to make their weighting in the S&P 500 even larger than before, where the top 10 companies in this index now make up for roughly 30% of its total value. That's a pretty large discrepancy in terms of the weight of this index versus the amount of companies that it represents in the S&P 500. So by no means are we seeing an overall market crash. Of course not. In fact, the market's continuing to rally along. But in terms of companies that gained a lot of momentum during the pandemic for certain specific reasons, what we're seeing extremely large corrections on these positions. Quite a few companies that made tremendous strides over the course of the pandemic are getting absolutely hammered right now, as they had exceeded a valuation that really made sense regarding their underlying financial growth. But even still, I'm talking down more than 50% from their all-time highs in some cases, and not just small cap penny stocks. Companies like TDoc down 50%, Zillow down 67%, Fiverr down 51%, Peloton down 67%, and the list goes on. So in reality, although the S&P 500 is continuing to climb to all-time highs, it certainly isn't sunshine and rainbows across the market, even though that's what the media tends to focus on, these polar extremities. Even in my own portfolio, some of my holdings have got absolutely destroyed over this past earnings week, specifically companies like Trulieve Cannabis, as well as Lightspeed and Corsair Gaming. In fact, if you've been following the channel, well, Corsair and Trulieve have been some of my longer term plays, but they've just been complete dogs in my portfolio, even though I do continue to have conviction in their longer term growth based on the underlying growth of their businesses as well as their financials. For example, though, Lightspeed didn't necessarily have a bad quarter, but it is down 35% from the trading last week at around the $120 Canadian per share range, which represents around 50% down from its all-time highs. The company grew their revenues by 193% year over year to $132 million. That being said, quite a bit through acquisition, but still their core business grew by roughly 60%, which remains a lot, and their transaction-based revenue segment grew by 320%. Even though the company's bottom line was their largest ever on a per share basis, their adjusted EBITDA margin loss was also similar to that of last year's. So the overall current investor outlook on unprofitable companies seems to have shifted quite a bit from only a year ago, where it was top line growth that really trumped everything else in regards to the future prospects and growth of a company. At this point, it really appears like so much anticipation is already priced into equities, both positively and negatively. And then when these companies are announcing their earnings, investor reactions are extremely dramatic. Overall in the markets, though, valuations have been and remain quite high, with high expectations across the board really for equity growth. There's no other way to justify this high level of valuation that we've been seeing. At this point, if you've been following the channel, these charts are probably quite familiar to you, where we're seeing the forward S&P 500 PE does remain higher than the 5 and 10-year averages versus the median PE, which shows us that the top 100 companies have a lot more pull on the overall market. And still, we're seeing more relative value in the mid and small cap stocks. Let's now briefly mention interest rates, as this is a market update video. Now, on the Canadian side of things, the Bank of Canada says that inflation appears to be less temporary than it originally thought, and that the main forces pushing up prices, higher energy prices, and pandemic-related supply bottlenecks now appear to be stronger and more persistent than ever. Realistically, this was pretty much a given, so I'm not really sure why they're acting surprised at this point, but right now they have also mentioned that they're looking at increasing interest rates in the first half of 2022. So what really does all of this mean for you, the investor, though? The way I see it, if you maintain a longer term investment strategy, not much. Ever since I started this YouTube channel around 3 years ago at this point, starting to talk about financial content and investing, well, even though it's kind of boring to repeat this over and over, there's a reason why I maintain usually around 50% or more of my entire portfolio in broad market, low cost index funds that track indexes like the S&P 500, NASDAQ 100, and so forth. Because think of it, over the past year alone, the S&P 500, although it's appeared to be at a high relative valuation over this period of time, has actually continued to rally by over 30%, which is an above average yearly growth rate, but confirms the reality that market movements don't always follow technical indicators and metrics. So being properly diversified and fully exposed to the markets is always something that I've recommended, and is something that goes back to multiple years back on the channel as something that I think most investors should consider. I love hand selecting and cherry picking stocks I think will perform better than the market, but as always, well, I have some stocks that have performed better than the market, the Go Easies of this world, the Lightspeed, even though it got crushed this past week, as well as Shopify and a bunch of other stocks. But then there's also some that I've selected that have not performed up to par with what I believed they would be doing in the shorter term, even though in the longer term, I do think that we'll see reversals, right? The True Leaf Cannabis of this world, the Corsair Gaming, and so forth. In fact, as much as you can do technical analysis, and some people will say otherwise, predicting short-term price movements in the market accurately and consistently over and over again is almost impossible. But it's almost a sure fact that over a longer-term investment strategy of at least a 6-year period on companies that are financially growing and expanding their market share, you're 90% sure of yielding positive returns in the overall market. That said, this would be through an exchange rate fund that tracks the overall market. All right, so that pretty much wraps up today's quick market recap video on what happened last week. I really hope you enjoyed it, and if you did, of course, smash the like button and check out these 2 videos that I posted this past week on the channel. One of them going over a TSX master stock list for 2022, all companies that I do hold, as well as a top stocks to watch moving towards the end of the year that are American positions. And if you want to learn more about stock market investing specifically, make sure to subscribe to the channel, hit that bell button to be notified of new and upcoming content. And I also have dozens upon dozens of videos already on the channel that I'd highly recommend you check out. So with all that said, thanks a lot for watching today's video, and I will see you in the next one.